But there's a lot going on there. There's a lot more talk about ESG today than there was a few years ago, and that the nature of that conversation is changing quite quickly and maturing. ESG integration is obviously something that's increasingly widespread. UNPRI membership's growing, and most major managers are either signatories or doing the things that membership involves. ESG products have performed well over recent decades. If you look into that, that's largely to do with low exposure to traditional energy, oil and gas, and a bias towards high ESG rating companies in areas like tech and healthcare. But that performance is sort of supporting the concept of ESG in the short term. We're seeing increasing focus on stewardship expectations of managers. And that's not an unreasonable expectation. I don't think that it's something that's going to go away, and it's tied to an increase in sort of regulation around ESG disclosure requirements and the like, particularly in Europe. But I think that the big trend for investors now is you're seeing a delineation between different types of responsible investment, between traditional ESG approaches that were largely or are largely centred around understanding ESG risks and managing those within portfolios, and other areas like ethical investment and activist and engagement investment and sustainably themed and impact investment. And the distinction between those strategies which are focused on investing in better companies, which is a perfectly valid approach, from an ESG perspective, investing in companies with characteristics that conform more closely to best practice, and differentiating between that and investing in companies that are doing things that are going to make for a better, more sustainable planet is becoming clearer. And there's an increasing array of data that's able to help people understand the nature of different ESG products and what they're delivering